Now let's bring in the #1 ranked analyst on the shares. We have Ben Stretch. He joins us from our New York studios, and Ben is with Macquarie. Okay, Ben, let's break down these numbers here. Let me just ask you, we have Disney shares trading in after hours lower by 3.5%. What is it that Disney said on the conference call, the analyst call, that analysts are not liking?
Well, the headline number of 48 cents definitely was a beat. The revenue was well ahead of our expectation, and operating income was well ahead. But unfortunately, most of that was driven by the studio. Alice in Wonderland did exceptionally well, driven by this 3D trend that's underlying a lot of the studio earnings this quarter and last. What the market is not particularly happy about is the performance of the media networks business, in particular ABC, where revenue and operating income really there have not jumped back at the same rate that we perhaps would have hoped, given the strength that we've seen in the scatter market and advertising CPMs, especially as we look at sort of the comparable performances of companies like CBS. And really, this is a ratings issue.
Yeah, this is a ratings issue. Let me ask you, though, about the movie business, because it's going strong. We talked about Iron Man 2, you know, the #1 movie at the box office over the weekend. In fact, I think the 5th best opening weekend ever for any film. And then you have Alice in Wonderland. Can this part of Disney's business drive the rest?
Yeah, I mean, it's really important to put this all in context. The studio of Disney in fiscal year 07, so just a year and a half ago, generated $1.1 billion operating income. I think now that they've got $500 million of income already locked up after these first 2 quarters, so in the first half of the year, I think we can actually get back to $1 billion of earnings this year, which is a pretty phenomenal bounce back from the number we did last year, which was around about just under $200 million. And there was all this negativity around, oh, the studio can't perform if the DVD business isn't working. Well, actually, I think they're going to prove that wrong. And I think we can actually see $1 billion studio operating income number this year, which I think will instill a lot of confidence back in the creative slate and creative capability of the Disney studio.
Yeah, sounds like it. So going forward, are you going to expect Disney to continue beating the street then?
Yeah, I think that the numbers that the street has for the rest of this year for fiscal 10 were about $2 in earnings per share. I don't think we'll see a lot of movement in that number in the next 24 hours or so as analysts chop and change their figures. I think the number's about right. I think the earnings multiple at the moment is about 17.9 times fiscal 10. It comes down to about 16 times fiscal 11. You know, I think the stock actually still looks reasonably compelling value, and I think that the management team has set themselves up very nicely for when park margins can bounce back once they can wean themselves off discounting in order to get people through the gates there at Disney World.
Yeah, okay. Well, Ben, let's talk about target price, shall we, and upside, because it looks like the average analyst on the Bloomberg terminal is calling for $37.60 for Disney shares, which is trading at 35 and change. Now, your target price is $36, which is not far from where we are right now. Are you thinking of raising that?
Yeah, well, I think if I look at my valuation for the company, I think I come back to I have a parks and resorts segment of Disney that I think will really recover in fiscal 11 as margins come back and sort of the general economic recovery helps them to raise prices. As I look at the studio business, I'm telling you that I've sort of seen half $1 billion of operating income generated already this year, with Toy Story 3 and Iron Man still to contribute later in the year. And I have a media business that I still very much believe in for Disney. I just think they need to do something about their ratings and help keep managing their cost base the way they have been in order to actually get the leverage as those ad dollars come back. If they can do those things together, I think that there is significant upside to where we currently value and where we put a price target on the stock right now.
Yeah, doesn't ABC make Desperate Housewives? Are you saying you're not a fan of that TV series then, Ben?
No. I watch plenty of media, given the role I have, and Desperate Housewives does very, very well. Just unfortunately, there's a few other networks that've got some pretty competitive content right now as well.
All right, Ben, I can see you in Wisteria Lane. Thank you for that. Ben Stretch of Macquarie joining us there from New York.